Still with me in studio this evening are Andrew Dittberner from Cannon Asset Managers and Gary Boyson from Rand Swiss. We're taking their stock picks for 2017 and we'd like to have yours. Please SMS them or email them to us, and also email us or SMS us questions. And just let's have a quick look at what's happening to European markets. American markets are closed today because of the Martin Luther King public holiday, but European markets didn't have a great session. I think at last count the CAC 40 was down about 0.75%. The DAX was off 2/3%, well, the CAC 40 has extended its losses, and the FTSE down just over 10% today. There is a question saying, will capital and counties be a good buy this year? And I suppose in today there were fresh jitters regarding sterling. Theresa May is going to give a speech tomorrow outlining the plans for Brexit. Could these be the turnaround stories of 2017 potentially, because they were so hard hit by the UK vote last year and also the collapse in the pound?
Yeah, I think capital and counties is looking exceptionally attractive at current levels. I think it trades 50 Rand or just below 50 Rand. When you look a year ago, it was over 100 Rand or thereabouts. So it's been absolutely hammered. And this is obviously on the back of a stronger Rand as well as the Brexit. They've got fantastic assets. I think their two assets are Covent Garden and Earl's Court. But there's obviously a lot of uncertainty around, whether there's going to be a hard Brexit, what's going to happen there. So I think, at the moment, you look at Investec's Australia Property Fund, that seems to be, the new big...
the next big
thing in property, and everyone's forgotten about London property. But I still think it's a great asset, and I think it looks very cheap. It trades at below its net asset value. So I think, again, if you can just sit out down the volatility, I don't think these assets are going to become worthless anytime soon. So
London is still a thriving hub and a tourist destination of regard. So
I'd be very comfortable owning it or even buying it at these levels.
Okay. Gary, how about you?
Yeah, I agree. I think the margin of safety there is significant. Again, obviously we've got Theresa May talking tomorrow, so maybe we'll get an upside. Maybe she won't be what we call it hawkish about the hard Brexit, and you might get a little bit of surprise, see a little bit of a kick up in the counters. But I think you are buying these at significant discounts. You look at again, the location of the assets is fantastic. If you know London well, Earl's Court is not quite Kensington, but it's very
Kensington aspirational.
Aspirational. It's almost Kensington. Like it can almost charge Kensington prices. So it's. Yeah, I think they are fantastic assets. There is huge concern, obviously, if head offices do start moving out of London, if London's not seen as the financial capital anymore. Already you've seen property speculators moving into Paris, Brussels, Frankfurt is another big hub, buying up B plus and A grade property, and we've seen prices going up almost in anticipation that some of the big corporates will have to vacate London, but it hasn't happened yet. So,
and in fact, you've had two companies, I think Google and Snapchat Snapchat, I don't know if you can call it a big company, although if they list this year and they have a fantastic valuation, then I guess they can be highly regarded, but they've both chosen the UK as their sort of European base.
And the UK is fantastic for that European base as long as it's part of the common market, but it's, again, as you say, it's a cultural capital. It's a city that I don't think is going anywhere. It's been around for 2,000 years plus. It'll be around for another couple of hundred.
Okay, so 44 rands.
Yeah, I think it's not bad. I don't think you're facing too much more. I think there is a margin of safety, whether you're going to see the turnaround this year, next year, in 5 years' time, but eventually it should pay off, I think.
Just maybe a quick comment on the Investec Australia Property Fund. So they bought 2 new properties in New South Wales for 160 million Australian dollars. They've announced a rights issue. In fact, their share price ticked up above the price of £13.50. Is it possible that we might get burnt buying properties that are sort of piling headlong into Australian property, or do you think actually maybe that is the place to be looking this year?
No, I don't have any preference whether it's Australia, England, South Africa. When you're looking at a property company, you want to see that forward yield. You don't want to overpay for the asset, so you want to see it trading, at a slight discount to its NAV. And you don't want to see vacancies ticking up. You want to see them going the other way. So I don't have a preference to where you buy the property, as long as you got those characteristics in place, I'd be comfortable, owning property anywhere, as long as it's also a good quality asset.
Yeah. Gary, any just quick comments on any of the sort of Australia-focused property companies?
Yeah, again, I don't know. I don't have any view as the vacancy rates or the specific assets that you'd be buying. But just Australia in general, I mean, it's a sound developed market as well. The property rights are protected. I don't know if I would be buying things in maybe Central Africa. We could get into a bit of trouble. But I think there is. The rule of law and order in Australia is fine. So going in from that point of view, but also looking at Australia just generally. I mean, again, Australia has benefited massively from a resource boom. Should the commodity prices start to slide heavily again? I mean, Australia is also fairly well-fed dependent state, and the Australian economy could get into a fair degree of trouble. And then if it's very office-focused property as well, you're going to see vacancy rates increasing. So I would be concerned. But as for those actual assets, I couldn't really comment.
Okay. There's a question on consolidated infrastructure. Unfortunately, it's cut off, but it talks about having traded high volumes today. So maybe a comment on that and whether or not, and what you make of the company. I think that's my stock pick for 2017, actually. I own it, so I think I might be adding to it. That's my caveat. Andrew, do you look at it?
Yeah, I think it's exposed to the right markets. Obviously, it's very much African-focused. Electrifying Africa is a big part of its business. Then it's got a business in Angola that is dependent on the oil market, which obviously oil prices we've seen ticking up now. It cleans up after oil rigs, if I can put it that way. They've just recently done quite a big rights issue in their life and bought a prepaid a business that you prepay for electricity, etc., called Conlog, I think it is.
Yeah.
So they're fairly busy at the moment. I think they are exposed to the right sectors. The African story, whilst it's come under pressure, obviously over the last few years, obviously oil in particular has hurt the likes of Angola. So we've seen the share price under pressure. I think it trades low 20s somewhere. It's been as high as 35 Rand.
Yes.
So I think it looks exceptionally attractive at these levels. I don't think there's anything wrong with the business. I think it's an excellent business. The management team role has done a superb job there.
Yeah.
It's obviously just got negative sentiment given that African exposure and what the oil price has done. But
you'd back it. Yeah. Gary, do you have any explanation for the high volumes, and does that maybe attract one into a share if you start seeing greater volumes in shares that have been unloved for a while? Does that make you think twice about them?
Yeah, I didn't see the actual volume. I don't know how big the volume spike was, but it's always difficult to read price direction to volume. It just means some big seller might have found a buyer, as well. So I think it's difficult. Someone's obviously got a fairly high conviction on it. If you listen to my former colleague Anthony and Keith as well, I mean both the guys that really focus on the small cap sector absolutely love this one. They can't understand why it's not at least at 30 Rand. I mean, it was also, if you look at my, we've also got an office competition running where you pick 3 stocks. It's one of my 3 stocks in there as well.
Okay.
And again, I mean, I think it got as low as, it was just sub 20 as well. So I've got alerts on, I'll be buying from my own portfolio as it approaches that 20. I think there's significant upside from there. I think Andrew's covered all the major points. I mean, Conco as well seems to be their core business locally, which is doing well.
Yeah.
And if you listen to Anthony, that Angolan business is completely misunderstood by the market. That is why it is down where it is. Everyone is linking it to oil, but as Andrew correctly pointed out, it's cleaning up after the oil companies. And the oil price doesn't actually affect its revenue in any way other than perhaps a complete cancellation of oil operations in Angola, which we can't see happening. So
okay,
I think it's a good one.
Okay. Oh, good. I'm glad to hear that. The panel's view on combined motor holdings. I'm afraid all the questions are being sort of cut off tonight, and there are a couple of picks that I'll mention towards the end of the evening, so we'll get that sorted out. But I'm just interpreting these questions. But we had the new vehicle sales out last week for December and also for 2016 as a whole. They were horrible, and I don't think NAMSA is particularly optimistic about 2017. So would you buy a company like CMH?
Absolutely.
Absolutely.
I love the share. Combined motor holdings, I think it's exceptionally misunderstood. And as you point out, new vehicle sales last week and they were poor. Combined motor holdings are not, if you look what the earnings have done, and you look at the end of last year, I think the earnings were up like 20% over the year. So it's not particularly linked to new car sales. They sell a lot of second-hand cars, so in tough markets, people trade down. They don't buy the new vehicles, but they rather buy second-hand. Alternatively, instead of buying the E-Class Merc, they buy the C-Class Merc. So they're still seeing sales going through, despite what new vehicle sales are doing. Likewise, motor vehicle distributors actually make their money in after-service marketing as opposed to selling new cars. So your car still needs to be serviced, doesn't matter what the economy is doing. So that really helps them. They've then got the first car rental business, which has been going for a few years now. It's doing exceptionally well. That allows them to sell new cars into that pool, as well as resell their second-hand vehicles coming out of that rental pool. So that helps them. So they've got a lot of things going for them, and it's a misunderstood, and hence it trades on a PE of 7, a dividend yield of about 7.
So even though it's had a really good year in 2016, you would still buy it?
It's still exceptional. I think it's one of the cheapest shares on the market at the moment, and the most misunderstood.
Okay.
That's just my point.
Gary, well, okay, we can add that into the 2017 bag of fun.
But can I take that as my stock pick today? I don't have too much to add. I haven't looked at CMH in a huge amount of detail. So, the one thing, we're releasing our 5 to buy for 2017 on Friday. And when we were doing our rankings, it came up time and time again, always sort of top 10. So I think the fun, and that ranks it across a huge variety of fundamental metrics. So that is telling me from just a general quant scan that it is something that we should be investigating a lot further. So definitely potentially something there, but not one that I look at.
Yeah, I think the issue there is very liquid though. So it's very difficult to trade.
Excellent. So then just before December, I can just tick it up like 70, 80%.
Okay, I haven't left you very much time, I'm afraid, for your stock picks for 2017. Some picks that have come through so far: Master Drilling, York Timbers. I think, if I could get this computer to work, I'll mention a few tomorrow. But Andrew, yours is Nampak.
Yeah.
It's a bit of a dog, but is it a turnaround? Does it have potential?
Look, it's been incredibly hard hit. Obviously, consumers have been under pressure, and then they've got, similar to SIL, as we spoke about, they've got operations in Nigeria and Angola. So repatriating cash out of those countries has been very difficult. They've got they had a lot of US dollar denominated debt in those countries, which they obviously couldn't pay, and hence had to use the South African balance sheets to pay that debt. And we saw the dividend cancelled last year. They also had, a few issues with a couple of the operations. That's all in the rearview mirror now. I see you trying to hurry me up.
Sorry.
That's all in the rearview mirror. And I think we might see, depressed earnings coming out in the first half of this year. But from then on, I think we're going to see a really big turnaround. The share price has been hammered. I think it's very attractively priced at these levels. So
okay, so
that would be my pick for the year.
Okay, and then Gary, yours is PSG.
Yes, PSG. So I can only pick one stock. We take a portfolio approach, so I'm going to have to pick someone else's portfolio. I think the underlying businesses is a lower risk reward profile than some of the small caps that you could take, but I think it's a solid earner at 120, maybe a little bit pricey. Trying to get in, say at least 220, say 210, just sub 210, I'd be buying.
Okay, gents, sorry to have truncated your time towards the end of the show. Thanks very much for joining us this evening. Thanks to Andrew Dittberner from Cannon Asset Managers and Gary Boyson from Rand Swiss, and we'll be back with Stock Watch tomorrow night at 7:30.